Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Economic Trends to Watch in 2025, Insights for Smarter Decisions. Economic trends shape the decisions we make, from everyday spending to long-term investments. For businesses, investors, and policymakers, staying updated isn't just helpful, it's necessary. Shifts in global markets or national economies can create both opportunities and risks. By understanding these patterns, you can adapt faster, make smarter moves, and stay ahead in an ever-changing world. The role of economic indicators. Economic indicators are like the gauges on a car's dashboard. They help us monitor the health of economies and spot warning signs before problems arise. By tracking specific metrics, we can better understand where economies are headed and how that might impact businesses, consumers, and governments alike. Here's a closer look at some of the most important indicators that shape how we interpret economic trends. Gross Domestic Product, GDP. GDP measures the total value of all goods and services produced within a country over a specific period. Think of it as a snapshot of the economy's size and overall health. When GDP grows, it signals economic expansion, while declines often indicate problems like recessions. Policymakers, investors, and businesses use it to make decisions about spending and strategy. For example, in 2023, the United States saw GDP growth of roughly 2.1% in the second quarter, highlighting a steady, if modest, expansion. Meanwhile, China reported a 4.9% year-on-year GDP increase for Q3 2023, driven by a bounce back in consumption and industrial output. Studying these trends helps identify areas of strength and weakness in global markets. Employment data and unemployment rates. Employment data is one of the clearest windows into economic health. High employment typically reflects a strong economy, while high unemployment often signals underlying issues, like shrinking business activity or poor consumer demand. Unemployment rates, job openings, and labor force participation are key metrics to follow here. Globally, unemployment has shown mixed trends. The U.S. unemployment rate stood at 3.8% in October 2023, reflecting a tight labor market. In contrast, some European countries, like Spain, continue to grapple with higher unemployment rates hovering around 11.5%. Regional differences highlight how diverse the challenges and opportunities can be between economies. Inflation and Consumer Price Index, CPI. Inflation measures the rise in prices over time, and its effects ripple across almost every part of the economy. The Consumer Price Index, CPI, tracks changes in the prices of everyday goods and services, offering a clear measure of inflation's impact on households. In recent years, inflation has been a hot topic. In early 2023, the Eurozone saw inflation dip to 4.3%, a significant drop from the previous year's highs, signaling central bank efforts were cooling things down. Conversely, Argentina's inflation raced toward 120%, creating financial pressure on its citizens. Tracking CPI gives insight into whether economies might face rising costs or a potential slowdown. Stock market performance. The stock market often acts as a barometer for the overall economy. While it's not a perfect measure, rising markets generally indicate investor confidence and economic optimism. Declines, on the other hand, can hint at turbulence or uncertainty. From Wall Street to Tokyo, watching major stock exchanges provides clues about broader financial sentiment. For example, U.S. markets, including the S&P 500, experienced a volatile 2023 due to fluctuating interest rates and geopolitical uncertainties. Meanwhile, India's Sensex index reached record highs, fueled by investor confidence in the country's long-term growth. These shifts offer valuable insights into both global and regional economic momentum. Consumer Confidence Index, CCI. The Consumer Confidence Index measures how optimistic consumers feel about the economy. Why does this matter? Optimistic consumers tend to spend more, which drives economic growth, while pessimistic ones often tighten their budgets, slowing things down. In September 2023, U.S. consumer confidence dropped slightly after a summer high, reflecting concerns about inflation and interest rates. On the other hand, countries like Japan reported rising consumer confidence as wages increased and inflation appeared under control. These fluctuations remind us that consumer behavior can have a big ripple effect on the economic landscape. By understanding these key indicators, you'll have a stronger grasp of where economies are headed and how that might impact the bigger picture. Global impacts on national economies. In an increasingly interconnected world, no economy operates in isolation. Events on the other side of the globe can ripple through national economies, influencing everything from trade policies to local job markets. Understanding these global connections helps businesses, policymakers, and individuals prepare for challenges and seize opportunities. Geopolitical events and their influence. Geopolitical events like wars, political unrest, or international treaties can reshape economic landscapes almost overnight. When conflict arises, trade routes are disrupted, sanctions are enforced, and investor confidence in affected regions dwindles. This doesn't just impact countries directly involved, it sends shockwaves through global markets. Take the ongoing conflict in Ukraine, for instance. Energy markets in Europe were deeply shaken as gas supplies from Russia were curtailed, forcing nations to seek alternative energy sources. The ripple effects hit households with soaring utility bills and pushed industries reliant on affordable energy to the brink. Similarly, economic sanctions imposed on countries like Iran and Russia not only restrict trade for those nations but also create volatility for businesses dependent on their exports. On the other hand, treaties can have positive outcomes. Look at the African Continental Free Trade Agreement, AfCFTA, aimed at boosting intra-African trade by reducing tariffs and easing border restrictions. Agreements like these encourage growth by creating larger markets and attracting foreign investment, reminding us how collaboration can drive progress. Global supply chain challenges. The pandemic laid bare how fragile global supply chains can be. A single disruption, whether a port closure, factory shutdown, or labor strike, can send ripple effects across industries and borders. Supply chain challenges don't just delay products from reaching shelves, they impact jobs, pricing, and entire sectors. Consider how semiconductor shortages stalled production for everything from cars to electronics in 2021 and beyond. Automakers faced delays, leading to higher car prices and fewer options for consumers. Retailers scrambled to adjust inventories, which hurt small businesses relying on consistent supply. Add in natural disasters, such as the 2023 floods in Pakistan, and the situation becomes even more precarious. These disruptions highlight the delicate balance required to keep global trade running smoothly. For businesses, adapting means diversifying suppliers, reshoring production when possible, and reconsidering just-in-time models. For consumers, it often means paying higher prices or waiting longer for goods. In both cases, the economic toll can't be ignored. Exchange rates and currency fluctuations. Currency values are like economic mirrors. They reflect the strength of a nation's economy while influencing its ability to trade on the global stage. A strong currency reduces the cost of imports but can make exports less competitive. Conversely, a weak currency benefits exporters but can drive up the cost of imported goods, including essentials like fuel and food. Recent fluctuations in the Turkish lira serve as a striking example. In 2023, the lira's continued devaluation pushed inflation rates sky high, making life more expensive for millions. Businesses importing goods into Turkey faced significant cost increases, while exporters gained a temporary edge in foreign markets. Meanwhile, the US dollar's strength in the same year made American goods costlier abroad, creating challenges for manufacturers trying to compete overseas. Global currency volatility often reflects broader issues, trade imbalances, speculation, or uncertainty about government policies. For traders and businesses, keeping an eye on exchange rates isn't just a numbers game. It's a daily gamble that can determine profit margins or lead to sudden losses. By analyzing these factors, geopolitics, supply chain challenges, and currency fluctuations, you get a clearer picture of how global forces shape economic realities. Understanding these connections is key for planning ahead in an unpredictable world. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.